Let me tell you about the most expensive mistake in investing. It's not buying the wrong stock. It's not even losing money. It's waiting. See, most people hear the news. The Fed just cut rates. CNBC's talking about it. Their coworker mentions it at lunch. And then they open their brokerage app and start buying. But by that point, the move already happened. The stock's already jumped. And now you're buying someone else's gains. That's the trap. It feels safe to wait for confirmation, but in the stock market, confirmation is the tax you pay for being late. Today, I'm going to show you 5 stocks that are set up to move before the next big rate cut. Not after, before. And I'm not just going to hype them up. For every single stock, I'm giving you the real reason it could win and the honest risk that could hurt it, because that's what we do here on this channel. My name is Mike. Let's get into it. The setup. Why this moment matters. Okay, before we get to the stocks, you need to understand why this moment matters, because the setup right now is rare. Let me explain it simply. The Federal Reserve controls interest rates. Think of it like a dial. When they turn it up, borrowing money gets expensive. Mortgages cost more. Business loans cost more. Everything slows down. When they turn it down, money gets cheaper. Companies borrow, they build, they hire. The economy speeds up. And stocks? Stocks tend to go up. Right now, that dial is sitting at 3.5 to 3.75%. The Fed has already cut rates 175 basis points since September 2024. But then in January 2026, they hit pause. They said, hold on, let's see where inflation goes. And then, just a few days ago, we got the January CPI report. Inflation came in at 2.4%. That's below what Wall Street expected. Core inflation dropped to 2.5%, the lowest since April 2021. That one report changed everything. Before that report, markets thought there was maybe a coin flip chance of a rate cut by June. After that report, the odds jumped to 83%. 83% chance of a rate cut by June 2026. And here's something else most people don't know. Jerome Powell's term as Fed chair expires May 15th. President Trump has already nominated Kevin Warsh to replace him. If he gets confirmed, his very first meeting as chair would be June 16th. A brand new Fed chair under political pressure to cut right when inflation is cooling. You see where this is going? But here's the thing most people get completely wrong about rate cuts. They think every stock goes up. That's not true. Only a specific type of stock gets the biggest boost, and that's what we need to talk about next. The myth reframe. Rate cuts help everything. This is the biggest myth in investing during a rate cut cycle. People hear rates are going down and think every stock in their portfolio is about to moon. It doesn't work that way. Let me show you who actually wins. When rates drop, there's a formula Wall Street uses. It's called a discounted cash flow model. Sounds complicated, but the idea is simple. A company's value today depends on how much money it will make in the future. If a company makes most of its money right now, lower rates don't change much. But if a company makes most of its money years from now, lower rates make those future dollars worth a lot more today. Think of it like this. If someone promises to pay you $100 10 years from now, that promise is worth more to you when interest rates are low, because the alternative, putting your money in a savings account, pays you less. So the stocks that benefit the most from rate cuts are the ones whose best days are still ahead of them. Growth companies, AI companies, cloud companies, companies that are building the future. And history backs this up. In 2019, the Fed did 3 small rate cuts, not because of a recession, just as insurance. And what happened? The S&P 500 went up 31%. The NASDAQ went up 35%. Growth stocks crushed it. The setup we're in right now, it looks a lot like 2019. And here's something I want you to remember. The investors who understand this difference, the ones who know which stocks benefit and move early, they're the ones who build real wealth. That's who we are on this channel.
So now, let's get into the 5 stocks, starting with the most obvious one on the planet. Stock number 1, NVIDIA. Yeah, NVIDIA, I know, you've heard about it 1,000 times, but the reason it's on this list might surprise you. Most people think NVIDIA is expensive. They see the stock price and think they missed it. But let me show you something. NVIDIA's forward price-to-earnings ratio is 25. That means you're paying $25 for every dollar of profit you expect next year. That sounds like a lot, but NVIDIA's 10-year average is 61. The stock is actually trading at its cheapest valuation in years relative to its own history. And the numbers are unreal. Last quarter, NVIDIA did $57 billion in revenue in one quarter. That's up 62% from a year ago. Their data center business alone did $51 billion, 90% of total sales. They just launched their Vera Rubin platform at CES, which ships later this year. Their Blackwell Ultra chips have demand that management literally called off the charts. And on February 25th, just days from now, they report earnings again. Wall Street expects $65.5 billion in revenue. When rates get cut, NVIDIA benefits 3 ways. Its future earnings get valued higher, the big tech companies that buy its chips can borrow cheaper to build more data centers, and investors rotate into the biggest AI name in the market. 40 out of 42 analysts rate NVIDIA a buy. The average price target is around $256 to $264. That's roughly 40% upside from here. The honest risk. Expectations are high sky. When a stock is priced for perfection, even a great quarter can disappoint. If growth slows even a little, the stock can drop hard. That's the reality. Now, NVIDIA gets all the headlines, but stock number 3 on this list quietly made investors more money than NVIDIA last year. We'll get there, but first, let's talk about a stock that's been beaten down and could be ready to rip.
Stock number 2, Snowflake. Snowflake is down 54% from its 52-week high, and a lot of people see that and run away. I get it. A stock dropping that much feels scary. But let me ask you a question. If your favorite grocery store had a 54% off sale on everything, would you run away or would you fill up your cart? The answer depends on one thing. Is the store going out of business or is it just having a temporary sale? Let's look at what Snowflake is actually doing. Last quarter, Snowflake brought in $1.21 billion in revenue, up 29% year over year. They beat expectations by almost 13%. Their remaining performance obligations, which is basically all the money customers have committed to spend in the future, hit $7.88 billion, up 37%. The AI transformation is the real story here. Snowflake Intelligence, their AI platform, launched in November. It's already got 1,200 customers. AI revenue hit a $100 million annual run rate, and it's influencing half of all new deals. They just signed a $200 million partnership with OpenAI and another $200 million deal with Anthropic. This is not a company going out of business. This is a company at a turning point. Why rate cuts matter here. Snowflake is what Wall Street calls a long-duration asset. It's still not profitable on a traditional accounting basis. Its value is almost entirely based on future growth. When rates drop, the math used to value companies like Snowflake gets dramatically more favorable. The present value of those future dollars goes up a lot. 43 analysts rate it a buy. Average target is around 275 to 282. That's roughly 50% upside. The honest risk, execution. Snowflake still has to prove it can turn AI buzz into real, consistent profit. If product adoption slows or competition heats up, this stock stays stuck. That's the gamble. Most people see a stock down 54% and think damaged goods. The best investors see it and ask, did anything actually break, or is this just on sale? That's the difference. Stock number 3, Broadcom, AVGO. All right, this is the one I'm most excited to talk about because Broadcom is the stock that I think fits this channel better than any other. Let me show you why with one number.
If you bought Broadcom 10 years ago for about $15 a share, split adjusted, your dividend on cost today would be 17.3%. Let that sink in. 17% per year just in dividends on your original investment. That's before the stock price went up over 2,000%. Broadcom has raised its dividend for 15 straight years. The average growth rate, 32% per year. They just raised it again in December by 10%. But here's what makes Broadcom special right now. It's not just a dividend stock. It's also one of the biggest AI winners on the planet. Last quarter, Broadcom reported $18 billion in revenue, up 28%. Their AI chip revenue hit $6.5 billion, up 74%. And they guided for AI revenue to roughly double this year. They have 5 confirmed customers building custom AI chips: Google, Meta, OpenAI, Anthropic, and another unnamed company. Their AI backlog, $73 billion. And the safety net that makes me sleep well at night? $26.9 billion in free cash flow last year. This isn't a company running on hope. It's a cash machine that also happens to be riding the biggest technology wave of our lifetime. Why rate cuts matter here. Broadcom borrowed big to buy VMware for $69 billion. Lower rates reduce their interest costs on that debt. Plus, cheaper borrowing means more data center spending from the big tech companies that buy Broadcom's custom chips and networking equipment. 46 analysts rated buy, 0 sells. Target, 420 to 454. That's 30 to 40% upside. The honest risk? Customer concentration. A huge chunk of AI revenue comes from a handful of hyperscaler clients. If one of them pulls back or designs chips in-house, Broadcom feels it. But in a world full of hype and broken promises, Broadcom gives you dividends, cash flow, and AI growth. That's rare, and that's why it's the dividend hustle pick. Now, the next 2 stocks are where things get really interesting and really risky. One of them just signed a $9.7 billion deal with Microsoft. The other jumped 14% in a single day. Let's keep going. Stock number 4, IREN. This is the most controversial stock on this list, and I want to be completely transparent with you about that. IREN used to be a Bitcoin mining company. That's it. Mine Bitcoin, sell Bitcoin, make money. Simple. But something happened. The company looked at its massive data centers, its cheap power contracts, its cooling infrastructure, and said, wait, we don't just have to mine Bitcoin, we can rent this computing power out for AI. And then they signed a deal that changed everything. $9.7 billion, 5 years, 76,000 NVIDIA GPUs deployed from Microsoft's AI cloud. That's not a side project. That's a complete transformation. IREN has 4.5 gigawatts of power secured across Texas, British Columbia, and Oklahoma. They get electricity for about 3 cents per kilowatt hour. That's some of the cheapest power in the world for data centers. Why rate cuts are everything for IREN. Here's where it clicks. IREN is a capital-intensive business. They have to borrow billions to build these data centers and buy GPUs. They already secured $3.6 billion in GPU financing at less than 6% interest. They issued $2.3 billion in convertible notes. Every single time rates drop, IREN's borrowing costs go down. Their project returns go up. The math on every data center they're building gets better. Add to that, Bitcoin miners historically outperform early in easing cycles. Risk appetite returns, and IREN rides both the crypto wave and the AI wave. Some analysts have targets as high as $65 to $80. That could be 55 to 90% upside. The honest risk. I need to be real with you. This stock has a beta of 4.28. That means when the market drops 1%, IREN can drop over 4%. It swings hard, both directions. Bitcoin still makes up about 90% of revenue. The AI pivot is happening, but it's early. Last quarter, they actually posted a loss, and the stock dropped 14% in one day. If you can't stomach a 30% drop in a single week, this stock is not for you, and that's perfectly okay. Knowing your risk tolerance is one of the smartest things an investor can do. But if you understand the risk and want the leverage, IREN is unlike anything else on this list.
Stock number 5, Datadog. What if I told you there's a growth stock doing 29% revenue growth and 31% free cash flow margins? That's like finding a sports car that also gets great gas mileage. It shouldn't exist, but it does, and it's called Datadog. Datadog monitors cloud computing. Every time a company runs something in the cloud, Datadog watches it, tracks it, and fixes problems before they become disasters. The more companies move to the cloud, the more they need Datadog. They just reported Q4 earnings a week ago. Revenue hit $953 million, up 29%. They beat expectations again. The stock jumped 14% in a single day. Here are the numbers that blew me away. 18 deals over $10 million in one quarter. 2 deals over $100 million. Over 650 AI-native companies are now customers. Free cash flow for the full year crossed $1 billion. Why rate cuts matter here. Datadog is one of the first stocks that big institutional investors rotate into when rate cuts begin. Why? Because it has something almost no other growth stock has: real profits alongside real growth. When rates drop, its growth gets valued higher, cloud spending accelerates, and its cash flow becomes even more attractive compared to falling treasury yields. 38 out of 42 analysts rated a buy. Average target is 180 to 190. That's roughly 50% upside. The honest risk? The forward PE is around 58. You're paying a premium for this quality. If the broader market sells off or if cloud spending slows, Datadog's premium valuation makes it vulnerable to sharp pullbacks. But for investors who want growth and profitability in the same package, Datadog is hard to beat. So, let's bring it all together. NVIDIA gives you scale, the biggest AI company on the planet, trading at its cheapest valuation in years. Snowflake gives you torque, the beaten-down cloud stock with a real AI transformation story, poised to snap back if rates fall. Broadcom gives you balance, dividends, cash flow, AI growth, the stock that does everything. IREN gives you leverage, the riskiest pick, but the one with the most direct connection between rate cuts and profit. And Datadog gives you profitable growth, the rare company growing almost 30% while generating $1 billion in free cash flow. History says the market goes higher when the Fed cuts. AI spending is projected at over $500 billion this year, and all 5 of these stocks have analyst upside targets between 30 and 90%. The best time to position isn't after the rate cut, it's before. And now you know exactly which 5 stocks are set up for it. Now, I have to say this because it's important. I am not a financial advisor. This is not financial advice. Every single stock on this list carries risk. You could lose money. Always, always do your own research before you invest a single dollar. That's not a formality. I mean it. But here's what I want you to watch next. There's one ETF that holds several of these exact stocks, and I think it might be the single best buy of 2026. I'm breaking it down in the next video. Hit that subscribe button so you don't miss it. And before you go, drop a comment. I want to know which one of these 5 stocks are you most bullish on and why. I read every single comment. I'll see you in the next one. Keep hustling.